March 6th, 2021, John Ward, the Nash Cash Flow Group. Gonna do a little presentation here, show you a video that my friend Todd Langford put together. A lot of people will ask me, what's the rate of return? They've read things on the internet, and it's a really quite misunderstood concept. Yes, it's the power of what you do with the money that's in your policy, outside the policy, as you cash flow money in and out. But it's pretty powerful to see really what the rate of returns are for a safe, liquid, accessible, leverageable asset. And so I do want to share a little bit of information here. So I'm going to share the sound of the video, and then I'm going to pull up Todd. And I am going to interject, but the one thing I ask is that maybe you grab a pad of paper and something to write with, because there's going to be a couple numbers that I'll reference, and I'll jump to another future value calculator to verify or help you, verify his numbers. Okay, so without further ado, I'm going to let Todd talk.
All right, so let's look at the rate of return on a life insurance policy. So the funding calculator, which is one of my favorite calculators in here, because this is probably one of the most misunderstood tools out there in the financial world. It's been bad-mouthed by every other industry, and I think part of that's
He's talking, when he says tool,
because
he's talking about permanent life insurance as a tool.
Every other industry has figured out who the enemy is, right? And they're all attacking the insurance industry. And so when we look at this, I'm going to put in an age. We've got some values in here built in for a 35-year-old that we pulled in before this meeting. So
he's referring to a life insurance illustration that projects the numbers with your growth, with your premiums, and what the cash values will be, what the death benefit will be year over year. So he's already done that. He pulled it into his software, and we'll see some of that.
I'm going to go 35 out to 70. Now, understand in here, 35 to 70 is not 35 years, it's 36 years. Because it's age 35, finishing with age 70 is actually a total of 36 years. When I do this, I always like to go at least a year beyond whatever the level term is that I'm going to use in my calculations. And we're going to go in here and we're going to load stored life insurance data, because I already have it stored in a particular spot. Just pull up one there, and we'll pull up that 30-year term, even though we're not going to use it right away, and just put it in this. Yep. And okay. All right. Now what we see down on the bottom is an internal rate of return of 3.94%. Most of you have the ability to print the rate of return column at the end of the illustration. I would really urge you not to do that, only because internal rate of return is a very difficult thing for people to understand. Sometimes we'll help client understand it in here. Pull up just real quick, the life insurance values tool. So this is where the data was stored. And when we look at this stream on number one there, what we see is that internal return starts at a negative 34%. 38%, and it grows down there until in that 36 year we hit the number that we were looking at here. What people think in their mind when they see that is, I have all these losses, finally I get to a point where I'm earning 3.8, is that what it was? 3 whatever it is per year. Is that the way internal rate of return works?
Yeah.
Let me just stop here because I want to point out a couple numbers. When we got to age 70, This is getting cut off at the moment, but it was 2,069,234 at age 70, year 36. So write that number down as your net cash value at age 70. And then the number next to it, which is your net death benefit at age 70, is 3,385,303. And I'll point out why that's important a little bit later. He's also going to show you this 3.94% is actually a much larger number or a longer number. It's 3.93 and a whole bunch of other numbers. I'm going to do my best to get that into a future values calculator so that we can verify his numbers. And note here that they're putting in 28,450 for 30 years, but he's looking at things and how they work out to the age of 70. So I'm going to have to do a couple different things to make that happen to get the whole 36 years involved. But he's only putting in premiums and deposits until year 30.
3.9.
No. What internal rate of return does is whatever number it gets to, it means you earn the equivalent of that every single year. That's a hard thing for people to grasp. What do I mean by that? Well, let's go back to the funding calculator and put in or copy that 3.94% down there with all the decimal places. And let's put that up here in the annual investment rate. So what this is going to do is it's going to say, okay, what if you didn't put the money in the life insurance policy and you put it in an alternate account? And you can earn 3.94% every year. Now, if you look down at the bottom, what's the cash value we have at the end of the time frame? 2,069,234, right? That's what it would grow to. Based on that same cash flows in another account, an alternate account, let's look at the alternate account. What do we end up with at the end if we earn 3.94% with change every single year? The same $2,060,234, $69,234. So when we see an internal rate of return calculation, whatever number that reaches means you earn the equivalent of that every single year. But when a client sees that with those negative numbers and finally getting positive, they're thinking, I'm losing money, and I'm finally getting where I'm earning 3.94% per year. So the reason I caution you about using that is the client's not going to see it the way it really is.
So let me stop this for a second, right? I'm going to shrink this. I'm going to stop sharing so that I'm going to continue to share. Sorry. Let me get to this calculator here. All right, so we're going to do that 30 years. So 30, is the amount of periods number of periods that we do this. The starting amount would be 0. The interest was 3. I'm going to write this down. 3, 7, 5, 5, 17. 302949. All right, so we got that. The periodic payment here is going to be 28,450. And if you bear with me, I'll hit calculate. And you'll see that in 30 years, we had the 1.6. We're not quite to that 2,069,000. So I'm going to take this number and I'm going to copy it. And I'm going to say, this is the starting number, right? You can't see the whole number, but I'll try to show you that it's all there. 1.641, right? But now we're trying to finish out that 6 years, right? So I'm not continuing to put any money in at this point, but I still have this rate. Look, it did cut off some of that, so it's going to be really close. It's not going to be exact, but it's going to be really close. So if I hit calculate, you see is really close. I'm going to go back to this video, and we've got $2,069,234.12. Should be pretty much the same number that you wrote down earlier. So let me enlarge this again, and there it is, right? So it's it's spot on. So what he's saying here is, if you were putting this money somewhere else, 28,450 for 30 years, and then had it continuing to get 3.94% year over year, and pushing that all the way out, even after you stop putting the money in, you're still getting the 3.94%. That is the equivalent. So let me continue the video and go from there.
In most situations. Does that make sense? All right. So let's go back to the life insurance inputs. We see our 3.94%. When we're talking about rates and battling rates, people a lot of times don't get real excited about that number because we've done a poor job of explaining what that is. We didn't go through the principles. We didn't go through the objectives or wish list with the client so that we can apply that across the board. This is a safe, liquid asset. It is a certain liquid asset earning 3.94. That's the class that it belongs in. What in the world is earning anywhere near that today? Can anything touch that? So that is a tremendous rate of return. People ought to be happy about it. But when we compare that to invest, well, I heard you could do 25% in real estate. Yeah, but you're taking on a whole different risk scenario and everything else. For a safe liquid asset, this is a terrific rate of return. What is equivalent in safety and liquidity? CDs, money markets, checking accounts, can in the backyard, right? Are they doing 3.94%? And all except for the can in the backyard, are you having to pay tax on the measly earnings you're getting from those other assets annually? What if we were paying tax in a 28% bracket? Then what it would take in the alternate account to deliver that same $2,069,000, you'd have to earn 5.47% every year to pay the tax and end up with the same cash value. What if you wanted to protect your family in the unlikely event of a premature death? How would you cover that if you didn't put money into the whole life insurance? Term, right? You'd have to buy term. All right, so let's bring our term rates in here for $1 million a term. And if we scroll down, actually on this one, what a lot of other companies do is they push that premium way up. So what you would see is at age 65, that premium might be $50,000 or $60,000 for $1 million of coverage. And a lot of times people look at that and say, well, that's the insurance company trying to force somebody off the risk. For your knowledge, I wouldn't try to explain this to a client, but understand when an insurance company does that, that is the actuarial cost of getting that term insurance back on the proper mortality curve because they undercharged for it for the previous 30 years. That's not an overrated cost. That's the actuarial cost for getting it back where it should be for it going long. Okay, so when we look at this, what do we have now on our return? You can leave it all the way out on this one because it's not that high. They might actually keep it.
Okay.
5.71%. So you'd have to earn 5.71% in an alternate account every single year. And if you did that at the end of the time frame, you wouldn't be better than the whole life insurance. You would only have as much cash value and you would have lost the death benefit. And we could do that, but it's going to way overprice the cost on those last years because it's going to try to catch that up at those rates, so I wouldn't do it on here.
No, so does that make sense, right? In the other policy or in the actual life insurance, I pointed out, you can see here that you have on the bottom right, you have 3.3, almost 3.4 million death benefit. If you went and did this, similar thing by having some term insurance, it's going to eventually run out because that's what term is. And what he was pointing out is that if you try to, maybe you have a convertible, maybe it can convert into permanent life insurance. But when that happens, it's always more expensive because now you're older, you're closer to, um, you know, the end of your days. And so it's much more expensive to buy it at that point. What they've done when you were young was they put your money in the big pool with other people of your age. And of course, they know what the mortality rates are. So very unlikely when you're young that you're going to die young. And so the point is that you'll probably lose this life insurance. You'll have put all that money in there, and so you'd need that 5.71% just to be equivalent. But then again, you just lost, you know, over $1 million in life insurance. Well, technically, if you die, I mean, and you had no outstanding loans on this, you'd have almost $3.4 million that would go to your heirs. I'll let it continue.
But that's, where are you going to earn 5.71%? Well, the market's done an average of whatever for how long, right? Okay, if you do that, are you going to take on some additional costs in the way of fees? Well, let's add fees to this one. If we had 1.5% in fees, which is not nearly all of the cost that occurs there, basically you'd have to earn 7.32% every single year to pay the fees and taxes, and ultimately you would only end up with the same cash value and no death benefit. How could people say life insurance has a terrible rate of return? It's that one-liner that people buy. You say it 7 times and it becomes fact. But it's not true, is it? This has a terrific rate of return when we understand what it is. Let's take off the fees, Kim. And let's look at something real quick. Annual investment rate. Let's go to 2%. Let's say that we can get 2% in CDs. And I know there's some of those out there, but you ought to see the teaser deals, what you have to do to qualify for that behind the scenes. So it's not really. But if we look at it this way and go to the cash-on-cash comparison, here's a comparison. The life insurance policy is going to be behind this 2% account for 8 years. Is that true? Yeah, but look how much it's behind. In this case, it's never behind even a premium. And from the 9th year on, it walks away from it, and we have the death benefit.
So I think this is a really good place to stop. What you're looking at here is the center column there with permanent life insurance cash value of $2 million. And what you're saying is the alternate account would only be worth 1.1 million. And so the difference, the benefit of permanent life over some outside account, you know, like you're saying a CD, is 947,000, almost 948,000. That's the number. So if you subtracted the alternate account number at age 70 from the permanent life insurance cash value, you're going to come up with that 947,703.
And that's huge. That is huge.
Repeat, please.
And it has more liquidity. So here's the key piece here. Is the life insurance policy an and asset or an or asset? It's an and asset, meaning I can put money in here and I can put it in real estate or somewhere else. Are most other assets and assets or assets? Or
what his point here is that you have opportunity costs, right? You either go in one direction with most investments, right, that are or investments, right? I either do this or I do this. I can't do this and this. And with a permanent whole life insurance policy set up as an infinite banking policy, you're building up your cash values, you're utilizing leverage to get at that money, and that money continues to grow, never diminishes in value. You get guaranteed rates of return inside. You also historically have received dividends. Once that money is put into your account, that will never go down. So that is always growing, but you can always leverage the money for another asset.
One of the things that Nelson Nash said was, when you are in a position of cash, opportunity will seek you out. If I'm in a position of cash, can I take advantage of what might come along, that once-in-a-lifetime thing, because I'm in a position of cash in my life insurance policy? So there's so many bigger pieces to the way the life insurance policy works, along with the certainty that it provides for the uncertain assets that I might want to invest in.
So I just want to finish up with a special offer here. I love what Todd does here. I also love what Brian Bloom does in his book, Confessions of a CPA, The Capital Equivalent Value of Life Insurance. And I'm going to read this. I've posted this kind of quote before, but I'm going to read it again. And it says, when you fully understand the concept of allowing your money to compound forever while using someone else's money to spend, then the volume of money is more important than the rate of return. After all, at the end of your life, when you reflect on everything you have accomplished, would you rather have had a higher rate of return or more money? So Todd's talking about the ability to do more than one thing with your money, that and asset concept. What Brian is talking about in his book is really the more money you have that you've built up in one of these policies, the more money you can stream to yourself in a tax-exempt retirement cash flow. That's the power. So here's the special offer. The book on Amazon goes for $29.95. You can get it with Prime, that type of thing. If you watch this video and you want a copy of this book, I will send it to you for $20. I will also pay for the shipping. You just send me a note, reach out to me. You've got all through this newsletter, you've got all my contact information. Go to my website and so forth and so on. But shoot me a note, say you would like it. I'll reach out. We'll get the $20 in my hands somehow, and I'll send you the book. If you don't like the book, which I can't imagine that you won't, I think it'll be eye-opening at the very least. It's an easy read. It's like 100 pages. It's the best book for anyone trying to understand how they've been kind of snookered. And I want to help you, but if you don't like the book, let me know. I'll give you $20 back. You can send the book back to me, and yeah, I guess you'd pay shipping on that direction if we aren't near each other. But with that said, I hope you guys have a great day, and I'll talk with you soon.